Good morning, everyone. Shelley, thank you very much indeed. I realize that in your day jobs, generally you're keeping a very close eye on people like me. So hopefully I'll give you a little bit of an insight into what we're doing in retail banking. And I think really to build on this message that Shelley laid out so clearly of the risks of not moving quickly enough. So, if we look at, the power of the mobile device that has been sweeping not just financial services, but every industry over the last couple of decades. Let me do just a quick show of hands, because this is always kind of a little bit telling. So, how many of you have ever owned a Motorola phone? So, looking around the room, almost everyone. Now, could we just do the same again? Ask how many of you own a Motorola phone today? One gentleman. You have really got your money's worth out of that device. Whatever you do, don't break it, because you won't easily find a replacement. But it has been an amazing journey over the course of these last number of years, and the disruption that these devices are bringing to almost every industry is both exciting and has the potential to be just a little bit scary. So this may reflect some of you. When I look at my kids, I actually think these numbers are a little bit understated, but effectively the vast majority of US domestic households have one of these devices in almost every person's pocket, and from the age of about 10. They spend 5 hours a day. That I would challenge is a little bit on the low side. I do worry a little bit that over time, if these devices stay the way they are, that humans will evolve to be a somewhat banana-shaped stoop as everybody walks along, and maybe with elongated thumbs. But we'll see exactly how that works through. And substantial amounts of e-commerce are now completed on that small device in your pocket or in your purse. And also, the major online players are beginning to evolve by setting up and moving into the physical space. Those companies which have typically been physical in nature are starting to go aggressively online. Order ahead is rapidly becoming a big factor in whether it's coffee or whether it's fast food. The geo-positioning capability in your phone gives the company the ability to figure out when you're going to be close enough that they can make your burger and fries or whatever that might be. Perhaps not salad, but because those can always just be ready. But they can figure out how far away you are so that when you actually drive up to the drive-through, that your food is hot and ready. And a number of businesses, and I think Apple have really led the way here, where their stores have truly become flagships for their brand. Also, I think we're in a cycle of enormous change in just something which, everybody's been very familiar with since 1958, was the launch of the credit card. Now there's a move rapidly into wallets. Chase are developing a wallet, Apple have a wallet, Samsung have a wallet, PayPal is a wallet. And so you see this explosion of activity around bringing more technical capability to the way that customers pay at the point of sale. And then on the right-hand side, what we look at is person-to-person payments. If I need to pay Shelley $25 for something that we split, a meal or whatever, is facilitating the ability for individuals to better complete a transaction electronically and without cash. And you see the number of fintechs actually on the right-hand side that are very aggressively moving into this segment, including ourselves and the other major banks. But as I move to the next page, you can see on the left-hand side, it's really an infinitesimal amount of volume which has really moved at this point onto those kind of mobile and digital capabilities. Some people might just simply argue that the simple magnetic stripe is not broken, but many of you will have experienced as risk managers and consumers data compromises. It's easy to copy those stripes away. If you put it next to a magnetic device, it'll wipe it out. And so, there are hindrances with the mag stripe which will rapidly improve as we move to a full online experience. And you see on the right-hand side of the slide, people say, well, again, the mag stripe's not broken, it's easy to pay on a day-to-day basis. People are concerned about security, and they haven't yet seen the full benefit of the wallet strategy. And I think what will happen is people like ourselves and Apple, Samsung, and the others that I mentioned will continue to innovate so that the functionality that will exist in those devices will just make it much easier than it used to be, that it is today, with a magnetic stripe, supply more data, more analysis, and more capability. So what does that mean for us? Shelley gave you some of our numbers. They are very large, 60 million US households, 45 million active digital users every day. I'm going to talk a little bit more about that. It's incredibly important. And those of you who've been involved in business for many years will know that if you go back a number of years, most companies were working to try and drive out the number of contacts that they would have to have with their customer in whichever industry they're in. Why? Because they're expensive. So if you think about managing a transaction through voice response, it's probably 50 cents. If you think about managing a transaction in a call center, depending on the duration of the call, it's probably $2, $3, $4, $5 or more. And if you think about the cost of dealing with a mobile transaction, it's fractions of a penny. And for marketers, it also gives an amazing ability to be able to speak to customers at a very, very low cost. More than $28 billion we have go through our quick pay capability. And while we're here today, our customers will generate more than 40 million debit and credit transactions. So what we've tried to do is to lay out just a very, very clear strategy for the businesses around payments. Consumer to business, by far the largest, people buying things, of course. We've tried to focus everything around the customer experience. And I think when we come back to managing risk, constantly grounding ourselves in what is the experience that the customer is having is one of the best vehicles that we can have for driving risk. Person-to-person payments I spoke about earlier. It's going to be a very rapidly growing space. And then finally, and equally as importantly, how do we integrate much more fully the experience that the customer has who is carrying a payment product with the merchant at the point of sale? And how do we bring the data that exists between the merchant and the financial institution to help to drive down fraud and credit risk issues? Shelley mentioned fintechs. We work exceptionally closely with the financial technology segment. It has seen explosive growth in the last number of years. I think they have been enormously successful. And again, I will go back to what have they done? They have focused relentlessly on the customer experience and shown many industries how to take what that industry has done for decades and greatly simplify it. 3 examples that we've used. TrueCar, you may have seen, make it a much easier process to purchase a car, whether it's new or used, by supplying data to the customer that helps them have a more informed decision. We partner with a company called OnDeck, which help us to onboard, to bring on new small businesses and to underwrite them much more quickly for a loan. And a company called Roosterfire, who help to take all of those documents. For those of you who have ever applied for a mortgage, you'll know that there are literally inches and inches and inches of paper that you have to sign. I'm not going to ask you to do this because you're a risk organization, but typically when I ask people, how many of you read all of those documents when you sign for a mortgage, 2 lawyers put their hands up and everyone else shuffles away quietly. So you can answer that question to yourselves, and I won't do a show of hands. But enormous opportunity to continue to simplify the mortgage process, the home buying process for customers. Interestingly as well, I think there was a cycle of tension I would describe between financial services and financial technology companies. One thinking that they would entirely disintermediate the other. It's become clear that operating in a highly regulated industry is not an easy thing to do. And now I see many more partnerships where the financial technology companies are looking for ways to distribute their product, partnering with the major financial institutions, and the two working just much, much more closely together. We also have, as Shelley mentioned, a very large retail network, 5,300 branches. They're incredibly important. So every time you pick up the newspaper, particularly around earnings seasons, there is more talk about the demise of the shopping mall, the demise of the retail experience. I speak to investors at JP Morgan Chase in a large group like this once a year in February, smaller groups much more frequently. And so each February I like to look and see, well, about 5,300 branches, each one has their own P&L, their own profit and loss statement. How many of them were unprofitable? It was about 9 of the 5,300. So they're an incredibly important component, and you can see the position we have on the left-hand side of the page. And so we are in the business of trying to continue to grow, nurture, and evolve the retail branch, the physical structure, while continuing, as you see on the right-hand side of the page, to really focus on the digital and mobile experience. And you see some of the positions that we hold in the industry that Shelley mentioned. And the bar graph shows that how rapidly households are starting to move their banking capabilities onto the mobile device. But then when we come and just look at the core of the business metrics, 75% of deposit growth comes from customers who use our branches. And I hear this same question almost every time, but Gordon, the millennials, what about the millennials? Well, millennials are actually the largest population as they're defined since we started to gather or as markers as these statistics. They range about 18 to 35, although I would argue that an 18-year-old has very little in common with a 35-year-old. But the range 18 to 35. The younger, the less they're likely to use the branch, the less they actually need a branch because they have very little money, they need very little consulting at that point. But as they move up that continuum and they're dealing with their student loans and they're thinking about how do I buy a house, they're thinking about how do I start to invest, then we start to see even the millennials start to use the branches. The branches physically are changing, they're becoming smaller, and the technology is moving to the front of the branch. The teller lines, the tellers behind the line are now moving out into the branch so that they can be there, they can be visible, and they can help customers. So you see the physical space continuing to evolve, and I'll show you some of the impact that that's had over time. If I think about the number of logins that we have from our customers, effectively it's almost every day. And now I'm going to go back to the importance of those person-to-person payments, cash if you like. The reason that P2P is so important for us, and we don't charge, so clearly we don't make any money from those transactions, is just keeping customers engaged with the bank. And having them feel that when you look at whose app is in those first couple of screens on someone's phone, we want the Chase banking app to be right there. In the center of the screen, quick deposit. So as risk managers, can you imagine maybe 7 or 8 years ago, somebody coming to you with the idea of saying, why don't we have a customer take a photograph of a check, which we could then deposit, and the customer would keep the check? I think your hair would likely be on fire. We did that 74 million times in 2016. And of course you could say, well, what happens if the customer goes to the branch then to deposit the check? They forgot, they try to deposit it twice, or they take the photograph twice. Trust me, we thought of that. And it works extremely well. And quick pay transactions, person to person, growing at the moment at around 30% a year. So very significant changes. And if you just look here now, with the advent of or the evolution, I should say, of what we used to think of as just a cash dispenser, now fully 90% of all withdrawals are done at the electronic device, and it's now just actually a little less than 10% is actually done by a person. Those machines, because they're hidden in a wall or bolted to a floor, you don't see very much going on. You can obviously now deposit checks with them. You can deposit cash with them. This is something that only I would care about, perhaps. But when one person deposits cash, another person can take that same cash out, so that the machines last a lot longer before we have to send an armored truck to refuel them. But you can see as you look down the degree to which automation is affecting every aspect of what we do. Now, as we bring all this together and you look at the various arrows here, I think the one which really yells out is the number of inbound phone calls into our organization, down 2 percentage points, while you see that rapid increase in the interactions digitally. And if you go back to the earlier point that I was making of a call costing $3, $4, $5 based on duration, and a mobile interaction costing fractions of a penny, you can see that the impact that begins to have on the economics of the business. There's still lots more opportunity for these mobile devices, and making the mobile device interact directly with the automated teller machines. And you can see here, a list of kind of effectively customer transactions that one by one will slowly be able to be on the automated machines. But there's some real complexity here. And interestingly, and it may not always be apparent, but we hire people from all types of industries to help build these mobile capabilities. Why? Because design is incredibly important. Simplicity of design, understanding exactly how customers use those screens, the use of color, the use of open space on the screen. And so the benefit of these apps is that they do a few things astoundingly well and very, very simply. And if you look to the right-hand side of the page, there's clearly an opportunity to add much more functionality. How do you add more functionality and still keep it simple and still keep it easy to navigate? Those are some of the challenges that our designers face today. Yes, there's a big opportunity to do more on the phone, but you can't make it as complicated as the websites in the mid-2000s. We once looked at our website in about 2008. We had 4,000 pages. Imagine the customer having to navigate their way through 4,000 pages, when effectively 15 or 20 are actually all that they used. So let's look at a couple of, I think, kind of really important learnings that we have had through this journey, and I think are very important for all of you, to look at everything through the customer's lens. And if you think about some of the issues that arose through the financial crisis, being focused back on the customer. And for those of you in risk management, if you're based in headquarters, I would strongly advise you to spend time out in the field, and with due respect to all of you, and I sit in headquarters too, where the real work is done, where our people meet our customers, is where you learn the most. Rethinking talent acquisition and retention. Again, pulling people from different industries. Sometimes folks who've been in the development of video games can be incredibly powerful for understanding how to lay out the next wave of mobile functionality. Agile development. How many of you have experienced in your time in business where investments in technology and very large changes, potentially hundreds of millions of dollars, are kind of laid out in an effort that's going to take 2, 3, 4, or 5 years? They almost always fail. And why do they fail? They're so large, it's hard to figure out what the environment's going to look like 3 or 4 years from now. And so those enormous infrastructure projects can be exceptionally difficult to manage. Small, agile development groups with very narrow bands of functionality delivering, often on a daily basis, but certainly within 2, 3, or 4 weeks. So to break down the technology change cycle into much more digestible chunks. We've also made great use of a term which is very broadly certainly used across financial services and many other industries, is Scrum teams. Just simply put, have people from each part of the business cycle working together in one area and taking a change and driving it all the way through, rather than business people handing requirements across to technology people, handing them on to risk and control people to review, and so a constant cycle is set up, rather than people sitting down together and working through what is the best possible outcome for the customer, how can we deliver something more quickly. You have to be a disruptor or you will be disrupted. The Motorola example is a good one. Most of us remember it. One might argue that if Blockbuster had embraced the online experience, perhaps Netflix wouldn't be where they are today. It is very, very easy to be disintermediated, and it is critically important to realize that standing still is a very conscious decision. Doing nothing is a very conscious decision and likely carries much more risk than some of the alternatives that people like to consider. And then the last point is relentlessly simplify things for your customers. And I think, again, if you go back I'll give you a personal example. We brought our daughter in, I think it was the holidays of 2001, an MP3 player. Anyone remember an MP3 player? I spent the entire morning of December the 25th trying to load 10 songs onto an MP3 player. I know you'll find this, shocking today, but I did. So, my daughter then listened to it for, an hour, and I don't think that MP3 player ever saw the light of day again. Disappeared into a drawer and was lost. And so if you just think about what Apple did to music and how simple they made it, we tried to look at every one of our business processes, our interactions with the customer, and say, how can you relentlessly simplify it? Because if you have to sit down and train your customer, you're going to lose that customer to someone else. So thank you very much indeed for your time this morning, and I think I'm now going to be joined by the panel. Thank you.